Let's address this right now. If you've been waiting for the Federal Reserve to cruise in and cut rates this year, I need you to hear this before you make another move. There is a 0% chance the Fed cuts rates at the next meeting. 0. And there is over a 50% chance that rates are going to be higher by the end of the year, not lower. Last month, the Fed was predicting this. In June, the Fed said it out loud. Here's exactly what happened and what it means for you and our San Diego housing market. I'm Karl Kyler, your San Diego realtor, and this is your July mortgage market update with Matt Kish from Movement Mortgage. Every month, Matt and I break down what moved mortgage rates, what the bond market is signaling, and what you should be thinking about over the next 30 to 60 days. There's no hype, no noise, only clarity you can make a decision with. With that said, let's dig into this. According to Mortgage News Daily, the source we use for all rate data because they update every single day, here's where things stand as of right now. The 30-year fix is at 6.64% and the 15-year is just about 6.25%. Jumbo loans are quickly approaching 7%. FHA, VA, and the adjustable rate mortgage are all sitting around 6.25% as well. Here's what stands out about June. After a wild ride we had in May, June was pretty quiet. Rates opened the month around 6.6%, drifted down to about 6.52% by the end of June, which was the lowest level we saw in 6 weeks, and they have ticked back up just over 6.6% in the first few days of July. That is a pretty tight range. On a $750,000 loan, which is close to what a typical San Diego purchase looks like after the down payment, the entire move in June was worth about $40 for the month. Compare that to May, where the rates swung by more than $140 inside 2 weeks. June gave buyers something they have not had in a little while, a stable rate to plan around. And here's what pushed rates during the month of June. A strong jobs report on June 5th nudged them up early. A hot inflation report on June 10th kept the pressure on. Rates eased a little into month end. A weak jobs report on July 2nd was helpful to pull them back down over the last few days. A reminder before we go any further, these are national averages. Your rate depends on your credit score, your down payment, your loan type, and your lender. Matt Kish is the person who turns these averages into your actual number. So what do these rates mean for you when you sit down with a lender here in San Diego? I asked Matt to break down the real monthly payment, what it takes to qualify in today's market, and the one thing you can control that moves your rate the most. Here is what he had to share.
Karl, depending on your credit, your debt to income level, your loan to value, right? All those, factors that kind of going in, like how much money are you putting down? What's your, qualifying credit at? What's your debt to income going in? We're still looking at about $700 to $800 a month for every $100,000 borrowed, right? So we're still primarily focused on the 3 C's. It's always going to be credit, collateral, capacity to repay the loan. The lenders are always going to focus on that up front when it comes to pre-qualifying you or pre-approving you. And then once we're in escrow and once we get this file into underwriting, there's always going to be a couple more things, documentation wise, or a couple questions that need to be answered along the way. But credit, collateral, capacity to repay the loan are going to be the things that us as a lender are going to need to verify for you to get a home loan going forward. And again, we're looking at about $750 per every $100,000 borrowed, depending on your credit profile, right? So the best things you could do is pay your bills on time. Keep that revolving debt that you have, your credit cards or any revolving debt, keep it at 30% or below 30% of the total balances, because that's going to reward you with the credit bureaus on a month-to-month basis. You could save. And what's really going to help also is keep working where you're working, right? Because the consistency of your job and your pay is going to help a lot when it comes to qualifying you for a home loan down the road.
Last month, I told you Kevin Warsh, the new head chair of the Federal Reserve, was trapped. He wanted room to cut rates and the numbers wouldn't give it to him. In June, we watched that play out and it went past trapped. The Fed changed its entire whole posture. It all started with inflation. On June 10th, the report showed inflation running at 4.2% over the past year. This is the highest reading in 3 years and more than double the Fed's 2% target. 2 weeks later, on June 25th, the Fed's preferred gauge called PCE confirmed the same story at 4.07%, another 3-year high. Here's the part that should get your attention. The numbers the Fed watches most closely is core PC. which strips out food and energy prices because those two bounce around the most. And right now, the war overseas is pushing oil and energy higher, which drags food along with it. So if this whole problem were the war, pulling energy out of the math should cool the number down. It did the opposite. Core inflation came in at 3.4%, the highest since October of 2023, and it rose from the month before. That tells you that this isn't only a war and oil story. Even with energy stripped out, prices keep climbing, which means inflation is spreading into everyday prices, services, and housing. This is the kind of inflation the Fed fears most because it's the stickier and harder type to bring down. So in their June meeting, the Fed did two things that mattered to you. They held rates steady, which was expected, but in their own forecast, they erased the rate cuts that had been penciled in for this year. And they signaled the next move is more likely a hike rather than a cut. And here's how the market's reading it. There's a tool called the CME Fed Watch tool that tracks future contracts to show the odds of what the Fed does at each meeting. Think of it as the market's live best guess. Today it shows a 0% chance of a cut at the next meeting and well over a 50% chance rates are going to be higher by the end of the year. Almost nobody is betting on relief. We remind you this every month. The Fed does not set your mortgage rate directly. Your rate follows the bond market. But when the Fed digs in against inflation like this, it keeps upward pressure on rates across the board. So the takeaway for you is simple. If your plan has been to sit on the sideline and wait for the Fed to rescue you with a cut, the Fed spent June telling you that rescue is not coming this year. Ask Matt Kish what he tells a buyer who's been sitting and waiting for the Fed to cut before they move. A lot of people are doing exactly that, and I wanted his honest take on what that waiting is costing them. Here's what he had to say.
If you take the historical view from 2023 until now, right? In 2023, that's when rates really spiked at the highest they've been in this decade, right? So from there to now, this 3-year period, rates have probably come down about a point and a quarter, right? From 7.5 or 7.75 to about 6.5, right? So taking back to what we just talked about, the monthly payment is going to be right about $800-900 at that point. So subtract that from the overall nut, right? So now from 2023 to now, you're saving about $800 on your mortgage. So what did that $800 in savings do to you in real time? Also, we've known the Feds have cut their rates a little bit, but it's been like a quarter a tick, right? So the Feds have lowered their rates not even a full point in that term, and we've saw rates kind of come down gradually on their own. So the Feds cutting their rates didn't have any effect on this point and a quarter difference in this last 3 years, right? They've just the mortgage rates have come down gradually on their own. If you've been waiting in those 3 years, what's really come of it? You've seen home values only go up, right? So have you saved faster than that rate of appreciation like we've been talking about? So if the answer is no, then we got to get you into a house sooner because you're never going to catch up, right? So you need to start earning that appreciation because you can't save at that pace. Also, you know that now we're looking at a volatile rate environment. Rates at the start of the year were really great. Then the war popped off. They've kind of gone up. Now it's been that accordion effect, right? So what has that done for you in real time? Knowing that, like we've been talking about, it's about $700 a month for every $100,000 borrowed. That really hasn't moved this whole year. It's pretty much been the same. Yeah, rates kind of gotten lower, but as far as that affordability factor in rate, it really hasn't moved that much this year. So now we're talking about savings and credit, right? The 3 C's: credit, collateral, capacity to repay the loan. We're already good with capacity because we know it really hasn't fluctuated. The rate really hasn't fluctuated that much this year. And so now we're looking at how much have you saved? Is it at a pace to where you could keep saving at that rate in a new home? And what's your credit? Are you still paying your bills on time? Are you keeping the revolving debts below or at 30%? And are you in good standing with the credit bureaus? Those are the 3 things that you need to focus on instead of all the existential things in the world. Like the Fed's going to do its thing. Mortgage rates are going to go up and down. Oil prices are going to be dictated on wars overseas, right? These are all things we can't control. What can we control? We can control our credit. We control how much we save, and we control where we. Those are what we got to work with. And if you're in good standing with those 3, we need to sit down and have a conversation, get you into these homes so that you could start gaining this appreciation you're so desperately trying to keep up with.
Now, for the other side of the story, because it's not all bad news, there is a path to lower rates that has nothing to do with the Fed. To see it, you need to understand one number that controls your mortgage rate more than the Fed ever will. That number is the 10-year Treasury yield. Now let me explain it in plain English. When the US government needs to borrow money, it sells what are called Treasury bonds. Investors buy them because they are one of the safest places in the world to park your cash. The yield is the interest rate the government pays those investors. And here is the key. Your 30-year mortgage rate shadows that 10-year Treasury yield almost step for step. When the yield goes up, your rate goes up. When it comes down, your rate comes down. But your mortgage rate is not the same as the Treasury yield. It sits higher, and the gap between the two is called the spread. Think of the spread as the cushion lenders add on top of the safe government rate to cover their own risk and costs. Historically, that cushion, it runs somewhere between like 1.5% to 2%. Now here's your opportunity. Right now, that spread is wide, sitting over 2%. And the 10-year Treasury is sitting over 4.4%. And the 30-year mortgage is over 6.5%. That gap is bigger than normal, which means if the Treasury yield never moves, then even if the Fed cuts rates, your mortgage rate has room to come down on its own if that cushion shrinks back towards normal. Let's put some real numbers on that. If the spread narrowed from 2.15% back to its historical 1.75%, that is close to a 0.5% off your rate. On $750,000 as a loan, that is around $220 a month or more than $2,600 a year without the Fed lifting a finger. That is why I watch the spread. It is a source of relief that does not need permission from Kevin Warsh or the Fed or anyone else on that board. We asked Matt whether he is seeing any of that spread relief show up in real pricing yet and what tools a buyer has right now to capture a lower rate without waiting on the Fed or the bond market. Here is what he had to say about that.
There's always going to be, how am I going to save $1.25 with my new mortgage? But again, in this tumultuous rate environment, it might be beneficial to take a little bit of a higher rate, let the bank pay you some money, knowing that you're going to save money down the road with a refinance. Or if that just sounds awful and you're just in it for the rate, what could we do for you, whether it be temporary, permanent, or maybe even looking at an ARM? I hate to say that in a rate environment that we're in, but we're going to look at every option on the table. Maybe an ARM on the day that we're looking to lock is something that you want to get into because you know that you're going to be out of this home in a certain period of time, and a 7-year ARM or a 5-year ARM at that rate at that certain period of time is what is going to be affordable and makes the most sense for you. So we're going to sit down, we're going to have all the conversations, run through all the scenarios and see where you're going to save the most amount of money in the amount of time you think you're going to be in that home.
Here is the big picture moving into July. Inflation came back. The Fed answered by taking rate cuts completely off the table for this year. The market is now betting on higher rates by December, not lower. That is the hard part. But here's the part most people miss. The gap between mortgage rates and the bond market is wide right now. And that gap is a real path to lower payments that does not need the Fed's permission. So here's my honest read. Do not sit around waiting for the Fed cut that the Fed itself says is not coming. If you find the right home and the numbers work, the smarter play is to buy now and keep the door open to refinance later if the spread closes and rates ease up. Waiting for the Fed has a cost, and right now that cost is going up. If you're also tracking the San Diego housing market itself, including the inventory, the pricing, what's moving and what's not, that's what my weekly San Diego Market Matters series covers. Go check out those videos next after you finish here. And if you have not subscribed yet, now is the time. Buyers who make smart moves this year are the ones who understand what the data is telling them. And this is where we sort through all of it together every month. Hit that subscribe button now before it files for its own rate cut as well. But don't worry, it ain't getting one either. As always, I'm Karl, your San Diego realtor. I'll see you next video.